Hello everyone and welcome to the First Source Market Share. My name is Erik Clapsaddle, Portfolio Manager in the Investment Management Group, and with me today is my fellow Portfolio Manager, Matthew Noll. As always, there is much to talk about in the economy and the markets. We've seen a lot of data coming in. We've seen some softer data coming in on the consumer side of things, and we've been talking about it for probably a year and a half to 2 years now, and that is just a softening of the labor markets, and we've really seen that kind of catch steam as of late. But on the flip side of things, we've really continued to see some strong numbers within GDP, positive economic output, and the fourth quarter is expected to even be better than what we've experienced the past 2 quarters. With that said, Matt, can you explain a little bit of the dichotomy we're seeing in the overall economy right now?
Yeah, so we're certainly seeing kind of the double-sided part of the economy, like you alluded to. The consumer certainly seems like they're slowing down. A lot of the payroll numbers we've seen coming out recently have been declining. Jobs are still growing, but the rate of that job growth has been coming down over the past year. Typically, when we see job growth year over year below 1%, that's more recessionary. We've been down as low as, I think, 0.4%. The most recent job numbers, that kind of jumped back up a little bit, but it's definitely been recessionary. When we look at retail sales, we just got data on that. That was less than expected. So those two things kind of point to the slowing consumer. But to your point, we're seeing GDP remain pretty steady. When we take a look at the first chart here, what it shows is that consumer spending, which usually does most of the heavy lifting for GDP, has clearly weakened. What's different about this cycle, though, is something else has stepped in to fill the gap. When we look at this chart, that something is business investment. A lot of that's tied to AI infrastructure and particularly data center spending. So data center investment has contributed almost as much as GDP growth over the past year, which is extremely unusual. Instead of a consumer-led economy, what we have today is kind of an investment-led economy. Growth hasn't disappeared. It's just coming from a very different place than usual.
So bigger picture on artificial intelligence and data centers that are following them in the towns. What is the overall economic impact from them beyond just the short term we've seen in GDP?
Sure. So what we've seen with the data centers now, AI is becoming more advanced. You need more compute power, more GPU chips, kind of bigger spaces to generate the AI data. When we take a look at this next chart here, it shows the spending by the 5 biggest hyperscalers, so Microsoft, Meta, Google, Amazon, and Oracle. This year, they'll spend over $650 billion building out data centers and filling them with processors, chips, and then an estimated $2.5 trillion with a T through 2029. So that's not just software, that's concrete, steel, power contracts, long-lived assets. That's where we're seeing the huge increase in contribution to GDP growth, where typically tech spending is not that material.
So what are companies doing to pay for all these capital expenditures? And we saw Google a few days ago issue 100-year bonds in the British pound, paying a little bit over 6%. What else are we seeing out there?
Yep. So we have seen debt increase quite a bit. I think Google had $20 billion, a bond that was being put out, and now they've got $30 billion with all the investor demand. So when we kind of take a look at this last chart, it shows that what's changed now is there's a clear pivot to using debt financing. So upwards of 40% of their spending, these big 5 hyperscalers, are going to be funded by debt now. Typically, that's funded with cash flows from operations. Again, what we're seeing when you start going to debt markets to fund these investments, it just flows through the financial system. It'll add to infrastructure lending and just overall economic activity. Typically, if that's taken too far, you start to see what we're seeing in markets where a little bit of uneasiness when you're using debt to fund things that aren't really fully vetted out in terms of growth with AI. It tends to make people a little more skittish.
Thanks, Matt. I appreciate your insight into, honestly, what is the most important subject in the overall economy right now. If you enjoyed this video, please feel free to share it with your family and friends. If you aren't subscribed to the Market Share, wait to the end of the video, scan the QR code, and enter your email address, and you will be subscribed. Most importantly, thank you for the opportunity to serve you and your family. Have a great day.